Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Daniel Lacalle, Peter Boockvar, and Ira Harris. Daniel holds a PhD in economics and is chief economist at Trespass SV, has been ranked in the top 20 most influential economists in the world. He's author of several books, including, most recently, Escape from the Central Bank Trap and Freedom or Equality. Peter is the Chief Investment Officer for the Bleakley Financial Group and Advisory at Bleakley. He has a newsletter product called the Book Report, bookreport.com, BOOCKREPORT.com. It offers great macroeconomic insight and perspective with lots of updates on economic indicators. And Ira is independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and a stint most recently. Welcome, gentlemen.
Thank you so much.
Thank you.
Great. I thought we'd begin with the overall macro views and thoughts on the economy and the financial markets globally. If you'd like to go first, Daniel.
Thank you so much. Thanks for having me. I think that if we want to categorize what is happening in the global economy, I would call it the big hangover. No? We're living the big hangover from the massive stimulus plans, huge indebtedness, and money printing that we saw in 2020 and 2021. And as 2021 progressed and we started to get more complacent about the estimates for 2022 and particularly for 23, things started to get a little bit worrying. I would start by, for example, showing to the people that are watching us right now that the IMF and the World Bank and the European Commission had an estimate of growth of the Eurozone that had not happened in the last 2 decades in any shape or form, with a multiplier effect of those stimulus plans that was unheard of. So there was a lot of complacency about growth expectations. We've seen those being trimmed down almost every month. And at the same time, a lot of complacency about inflation. Everybody, or at least the international bodies, were saying that inflation was nowhere to be found and there was not going to be any risk of inflation. Then it was going to be just a base effect. Then it was going to be temporary. And now I don't even know how they categorize it, but it's here to stay. No? So what I would say is much lower growth, much higher levels of inflation, even with the inflation expectations coming down, and the worrying signs of recession. Because if the United States can tolerate a recession with a low level of unemployment, that might happen. But it's not the case for so many of the developed economies, and certainly for those that still have furloughed jobs from the 2020 lockdowns.
Interesting. And your thoughts, Peter?
So the global economy is in a recession, and it's driven by, yes, the hangover from the stimulus and all the spending on goods, but it's also being driven by falling real wages, driven by high inflation that is putting people behind where they were in terms of purchasing power, and is now negatively impacting their spending decisions, on top of a rather short, at least in the US, a rather short increase in the cost of capital that is freezing up a lot of things. It's freezing up VC funding, you can be sure that a lot of companies did not enter 2022 that had a lot of floating rate debt, small, medium-sized businesses that were penciling in a 200 to 300 basis point increase in their interest costs. So that then crimps cash flows, and then that impacts hiring and capital spending and so on. So that's happening throughout. And it's something that we're going to have to now live through to see to what extent does this slowdown, to what extent does this monetary tightening temper this high rise in inflation. And it's going to take time. It's not something where you're going to snap your finger and we're going to be back to this magic 2% inflation level around the world. It's going to be something that's going to take a few years to cycle through. And yes, there'll be some declines in goods prices, and we're already beginning to see it. Commodity prices have come in, but I don't necessarily think that could be declared the beginning of a new trend rather than something that's temporary. But on the other hand, you have services prices that are high, and of the last few years of price pressures, it's going to take years of companies that are going to try to raise prices to offset their lost profit margin. So inflation is going to remain sticky and persistent, albeit at a lower pace. Interest rates are going to remain deeply negative on a real basis, and global growth is going to be in a true slog for a while. There's this debate that, okay, it's going to be a deep recession or a mild one. What we need to extend that discussion. Well, usually deep ones, you have rapid rebounds, whereas mild ones, yeah, maybe it's mild, but there is the possibility you have mild and lengthy rather than mild and short. And that's something that I think that we're going to have. This is something that's going to be extended. And taking it one step forward, typically in an economic decline, we know that central banks have come in all guns blazing, thinking that they can salvage the downturn, and they've had success, of course, in the past. But maybe this time it's going to be more challenging for them. Number one, because inflation is going to remain high, certainly relative to what they're used to in easing cycles. And number two, the economy is losing its beneficial stimulative impact from a cut in interest rates. Cheap money is not as cheap, but it's still cheap. So if you make it cheaper, is it really going to move the needle in terms of spending and decisions both at the household level and also at the business level? So this is a new cycle that people are not accustomed to. Again, the high inflation is going to handcuff central banks, both in terms of their ability to pivot on a recession and their ability to cushion any economic decline. And with the markets too, because we know at least the Fed is highly sensitive to where the S&P 500 is and where credit spreads are. And what are they going to do if the S&P is at 3,000 and credit spreads are blown out, but CPI is still 5%, down from 9, but still at 5, more than double where they want it to be. The markets are going to have to wean themselves off to this persistent dependency on the central banks are going to save the day and bail us all out.
In your thoughts, Ira?
Well, everything they talked about, and Daniel and I think we did one about 5 weeks ago, and I went back and listened to it the other day, and Peter told me when he listened to it, he said that was really a great piece, so a tribute to, and everything we talked about kind of unfolded here, especially with the ECB. We know Lagarde did Powell a favor by leading them out of the jungle of forward guidance. And we talked about that, that was a possibility. So that's a good thing. That's a good thing. So now his hands aren't tied. But Peter brought up a piece this morning, and I went back and listened to it yesterday, because it was the question from Colby Smith at the FT, in which he talked about that, well, we're probably at neutral, right? And I know you picked up on it, Peter, at 2 point, he said neutral at 2.25 to 2.25 to 2.5, which to me is far. First of all, the Fed has never defined what they mean by neutral anyway, right? To me, if you ask me, neutral is if overnight rates are at the inflation rate, meaning almost like a Taylor rule. So if we're at, let's say, 5% overnight rates and 5% inflation, that to me would be neutral because real yield would be 0. So I don't know what neutral, but I thought the market took off as soon as he said that yesterday. They heard what he said. Well, we're a neutral and our goal is neutral. We're kind of
They've totally conflated what neutral means, and the markets took that. Neutral was not meant to be some absolute Fed funds rate. Neutral was dependent on, was not all else equal. It was dependent on, if inflation is at 2, the neutral rate would be 2.5. There's another way of saying that their neutral rate is 0.5% real rate.
Yeah.
So for him to say we're at neutral doesn't make any sense. First of all, neutral rate is some made up number. They're based on one of their models. So when you have inflation at 9, the neutral rate's not 2.5. So I don't know what Powell was thinking when he made that comment.
I know it. I'm so glad you picked it up because I was scratching my head going, I know I heard that. And I went back and it was Colby Smith who asked the question and he definitively said that. And he didn't even try to backtrack from it. So, I mean, it's where we lie in the market. The market was relieved because I think they kind of sold themselves that, and recession, not recession, I don't know. I've never been a fan of the NBER definition because when I first read about it and was trading, and it didn't make sense to me because they were telling me we were in a recession 6 months after we had already known we were out of a recession. What does that do to me? It's silly, but of course, if you're lazy, it's nice to have it. I'm glad that he walked back. I thought he did a good job of walking back from it. But this is where we lie and where we're going forward here. I will say this, and I know we'll get to it. The yield curves have gotten interesting in the last 6 weeks because prior to that, it was the 530 curve that had inverted and was really flat, and the 210 was hanging around at 0. Now we have the 210 inverted and even taking out the lows, the inversion rate that we saw in 06, 07, which I think we got to negative 17 basis points in 06, 07. Now we got to 28, and yesterday we closed at 20 because the curves did, I thought, exactly what they should have, because the Fed's not going to be as tight. We should see some re-steepening out, which the Fed should actually like to see. I don't know whether they'll relish it, but I think we'll get to talk to those. And again, not one question about the dollar yesterday from the media. How do you not ask about the dollar? But we'll get to those. So I'm done.
What are your thoughts, Daniel, on the Federal Reserve statement yesterday, and also, for that matter, the ECB statement and actions in the last few weeks?
I thought that the Federal Reserve yesterday was very much looking backwards rather than forward. I think that when they were mentioning the situation of the economy, there was absolutely no concern about plummeting consumer confidence, about collapsing investment figures. We saw, look at today's GDP figure, by the way, look at the investment figure. So I think that the Fed is right now in a situation in which they have to maintain the same message about the strength of the economy, regardless of whether we are in a technical recession or not, because they know that until November, at least, or the midterms, it is a hike path, no matter what. So data could collapse in the next couple of months, and they would maintain the hike path, because the key factor right now is to get to a level in which the hike path is not questioned by markets. And I think that is where they are right now. The fact that markets are sort of reacting positively once the Fed says, hey, we're close to neutral. Boom, the market just, you see it going slightly up. The fact that things have not really become massively problematic despite 2 trillion reverse repo auctions is fine with them. The case of the ECB is significantly more different. Is that the ECB gave the most jaw-dropping statement one can imagine from a central bank. On the one hand, it says, oh, we're going to be tough. We're going to increase rates by 50 basis points, which is our highest and largest increase in 22 years. And at the same time, we're going to say to everyone that we're not going to reduce the balance sheet in any shape or form, because the entire proceeds of any bonds that mature in our balance sheet is going to be spent on bailing out Italy, which goes into its 133rd government in 160 years. So it is, fun and games yet again. Now, so that the ECB has told you not to buy the euro at all in the next 6 months, and the Fed has told you to be long the dollar at least until November, if November is the moment in which the central bank sort of U-turn, which I find still difficult, considering that the inflationary pressures that are starting to ease since March because of commodities, because of a number of industrial and food commodities that are correcting a little bit, is probably going to pick up once we get closer into winter. So, I think that so far, what the Fed is telling everybody is that if you want to have a little bit of confidence on a central bank, it is them who deliver on what they say to a certain extent, and while the others basically just flip around or around the edges.
And what do you make of the challenges in Europe of like the energy situation and also the bond market, including the overnight lending, repo market as well? Do you see an emerging crisis there similar to the great financial crisis or just before the COVID era?
I don't think that the ECB is going to allow a great financial crisis situation, and they're saying it over and over again. You see that the minute that the spread of BTPs, the Italian bonds against the Bund, go to a certain level, the ECB is immediately there. You see that in liquidity auctions, banks are always getting the ECB as a lender of first resort, not as a lender of last resort. So I don't think that is at least an imminent risk. And certainly, if there's anything that the ECB, also the Fed, are telling you, is that no matter what happens, liquidity is not going to drive credit shutdown in these economies. The problem of the gas situation, the natural gas situation with Russia, is much more important, because the European governments have decided to reach an agreement to voluntarily reduce 15% of demand. Voluntarily means that nobody's going to do it. Voluntarily also means that everybody is closing down agreements with not with Gazprom, but with Novatek, which is the equivalent of Gazprom but private in Russia, and it can still circumvent a little bit of the sanctions. So I think it's going to be a very difficult task, because it is impossible to offset the volumes coming from Russia with a 15% drop in demand, even if they achieved it, which they're obviously not going to. Furthermore, what I'm completely shocked is by the idea that it has to be a 15% reduction in demand from every country. So Estonia has to reduce 15% of demand. Belgium has to reduce 15% of demand. Luxembourg has to reduce 15% of demand, and Germany is 15% of demand. But out of the 150 BCM, Germany and Holland are 40%. So it makes no sense. You see what I mean? So I think that it's just one of those European decisions that always never ceases to amaze me. Now that they reach an agreement that everybody has to be involved in the same way when nobody has the same dynamics in terms of supply and demand. But it's going to be a very tough winter, because if there's not a shutdown of gas supply, which I think it won't, because where is Gazprom going to put the gas? More importantly, who's it going to sell it to? It's not easy. But it's either a much higher price or a shutdown of volumes. Either case is very, very negative for the European Union.
And your thoughts, Peter, on the European energy challenges?
Well, I agree with what was just said. Of course, when you have the equivalent price of natural gas in Europe at about $60, 55 to 60, relative to 8 or 9 in the US, I think that sort of hammers home the pain that both industry and households are facing. Households, now that we're sort of past this heat wave, they can manage through, until maybe October into November, where European industry can't afford even 1 second of disruption of natural gas because it can shut down an entire factory. So that's where I think, at least right now, is where the big concern is. Yeah. So if your home is a little hot during the summer, you can deal with it, but we can't deal with BASF shutting down one of their petrochemical plants because Russia decided to shut down natural gas for even just a day, let alone a minute or an hour. I think the 15% cut is almost impossible to actually implement, but I think it's them throwing things against the wall of how do we buy ourselves a couple of months where we can further fill our storage going into the winter. And right now they can't do it by getting more gas. They have no choice but to do it on the demand side. But again, how do you even implement that? With the ECB, obviously they're totally screwed. But the ECB became a different entity back in 2012 when Draghi did whatever it takes, because then it went from an institution that was supposed to replace the Bundesbank and focus on price stability to become basically an arm of the Eurozone governments and financing their debts and deficits. So since 2012, when Draghi started buying Italian BTPs and obviously started with Greek debt essentially, and then Portugal and Spain. That's what the European Central Bank became, and focusing on inflation then just became secondary. And while Draghi continued on with what went negative with rates and did what he did with QE, kept saying, okay, this is our way of trying to stimulate inflation, even though that was terribly mistaken in terms of that thought process. They just became further, deeper embedded in being an arm of these governments and in terms of financing. That I think they were at their peak QE, they were buying 7 times the issuance. I mean, give me a break. I mean, that's just a overkill. So now they're at the point where that's the number one focus is focusing on making sure that credit spreads don't blow out. So this TPI is really, as Daniel said, it's just an Italian government bailout program. That's what it really should have been called, because that's what really it is. And price stability, who cares about price stability when we have to finance Italy's debt to GDP ratio of 150%.
Absolutely.
No, I'm not. They've covered the ground here, so we'll go on to the next, I think, piece. But one thing I did want to add, going back to what we talked about the Fed, and I know we'll get more to Peter because he's really been covering this. But I mean, the Fed wants to talk about their data, and Europe has the same issue too. They're not quite there yet. But as Peter and Jimmy Bianco especially have really covered very well, The data for the releases last week, as we're getting more corporate earnings announcements, and why nobody asked Powell this. I don't care about the Fed data. You know why? Because the Fed, again, I'm going to go back to Peter. 18, 19 months ago, every one of his letters, when housing would come out, warned about the lagging OER and how that was going to screw the Fed. So when they were failing to admit that it was transitory, owners of equivalent rent was going to catch up to them, because it's just the way that data point is built. So you can come down now, you're stuck with the rent issue. But so now we're seeing, and he talks about how healthy and robust everybody is. But we had Verizon, I'm going back to Peter's points, AT&T, Walmart, auto repos are up into the sky, especially at the lower end of the credit numbers. Credit card delinquencies are rising dramatically, and yet nobody asks that question. So I'm waiting for when we're going to discuss that, and when is the Fed going to take that into consideration as to where we're at. But not one word about it. We heard was about 3.6% unemployment. And even in Europe has great unemployment data. So again, I'm never going to argue recession, that's a silly argument. But we're stuck here. And then is the Fed getting a little bit nervous because their focus is totally on unemployment? And maybe it ought to be on some things, again, around, I'm a capitalist. Everything happens on the margins. I know what the full picture looks like, but oil prices go up when there's one extra barrel of demand at the margin. I know what the regular oil, I know what natural gas demand, and I think Daniel and Peter covered it so well. And of course, Daniel made me laugh because, who's going to reduce the Spanish are already screaming about a 15% reduction, right? And, and the Dutch don't even say anything anymore. They let everybody else do the talking for them, because why should they appear to be the bad person? Everybody else will scream about it. So I don't know. Are you going to, the only way is, and Putin's sitting here laughing because what are you going to do? Shut down Europe for the winter? Not going to happen. So you figure it out. I can't.
Daniel, go ahead. Did you want to mention something?
It's impossible. It is impossible. The energy. We must go back a few decades ago and remember why Europe has a huge dependency on Russian gas. It is not a coincidence. It is not a mistake. It is not a policy conundrum. It's policy. It was a political decision. It was an absolutely thought political decision because it was the cheapest source of energy for Europe, and it was the only way in which Germany could actually implement a complete shutdown of its nuclear fleet and at the same time continue to receive inexpensive energy. So once you understand that, you understand why it is impossible for both Russia and Europe to actually deliver on their promise, whether it is of complete shutdown of natural gas to Europe, because all of the investments that Gazprom made with Ruhrgas, etc., were made precisely for that purpose. There's huge interconnection between companies. I mean, Ruhrgas, not just, but Gas de France in France, now called, I don't remember the name actually, or ENI, etc. So that's the first part. The second part is that the impossibility of translating the objectives of energy and CO2 reductions, in the Eurozone with the current mix that exists in most countries. Renewable energy is fantastic, but renewable energy works 22% of the time. That's a fact. And you don't change that in a few months. works 22% of the time. Therefore, for the remainder of the time, you either need massive nuclear energy, natural gas, or actually both, or hydro as well. Even if you have hydro and nuclear, you still need natural gas. So the problem is that something that was designed to have a cheap and reliable source of energy for the foreseeable future has become a tool that will generate expensive and unreliable energy for the foreseeable future. Not an easy one to solve. We must remember at the same time that the US is now the largest exporter of natural gas into the European Union, and that natural gas comes from non-conventional sources, fracking, which is banned in Europe. So basically, in Europe, it's banned to develop our own natural gas resources, while we spend, as Peter just mentioned, and it's an important figure, it's about $65 to $70 a million BTU to the price that was paid prior to the crisis. So any way you want to look at it, if you're Germany today, you're concerned about two things. The first one is supply of natural gas and price of natural gas. Second one is China. And we forget about China. In all this debate between economies, we forget that China just downgraded yet again its estimates of GDP growth, that they continue with the zero COVID policy, which between us is a subterfuge to disguise the collapse of the housing bubble. But either way you want to look at it, the European industry is having a huge problem. At the same time, we talked before about the euro and the ECB. The Eurozone is in a trade deficit for the first time in at least a couple of decades. So being in a trade deficit, which means selling euros to buy dollars, while at the same time having to sell euros to buy rubles to purchase natural gas, is a very tough combination added to the Chinese slowdown that means lower exports.
Interesting. And in terms of the US dollar as the major reserve currency of the world, do you think the Fed has more of an emphasis or an interest in raising interest rates to address the inflation challenges, especially in the US? Or is it also considering the US dollar denominated corporate debt globally, especially in emerging markets that are causing a lot of problems there? And are we actually seeing the Triffin dilemma in reverse? You know, speaking of trade deficits with a declining US dollar in the recent couple of decades or so, do you see it reversing with a stronger dollar happening? Your thoughts on that?
My personal thoughts is that it's not a problem, and it's not a problem because as long as the Fed remains the way that they are right now, which is there is ample liquidity, there is absolutely no problem in terms of access to US dollars globally. More importantly, in terms of dollar-denominated debt, emerging economies have been reducing their percentage of dollar-denominated debt to increase exposure to euro and yuan denominated debt, which ultimately, with the euro depreciating and the yuan depreciating while the US dollar strengthens, which means that their exports of commodities generate higher revenues, is not to say a positive, but it mitigates the risk of getting into a global financial crisis or an emerging market financial crisis due to dollar strength. So that is sort of kept relatively stable. What the Fed has actually proven yet again is that there is no contender in the fiat currency world to the US dollar. Yet again, we've been hearing for years in the period of bull markets, the yuan, that the euro was going to overtake the dollar, and that the dollar was going to disappear, and that Bitcoin was going to take over the dollar. Everybody was going to take over the dollar, except the fact that when push comes to shove, The US dollar is the house with the largest number of windows and doors in the middle of a fire, and that's what you want.
Okay. Interesting. And your thoughts, Peter, on the US dollar?
So I think it's important to not just look at the dollar as just this homogeneous currency against everything, because it has its own dynamics against different countries. And really, up until a few months ago, the dollar was only trading well against the euro, the yen, and the British pound. It was trading weak against the commodity currencies. I mean, a few months ago, the Brazilian real was at a multi-year high against the dollar. The Mexican peso, the Canadian dollar, all were trading well against the US dollar. Even the South African rand was trading well against the US dollar. It wasn't until the Fed took their rate hiking cycle from 50, well, it went from 25 to 50, and then 50 wasn't enough, and let's go to 75. And that really accelerated the dollar move against everything. Mm-hmm. And against the yen, it's obviously got its own advantages relative to how the Bank of Japan is running policy. Against the euro, it has, well, the deficit now that has been created from what was a surplus. I mean, that was a natural bid for the euro when they had a current account surplus of substance. And of course, the energy situation. But you can also argue that maybe a lot of the dollar strength is just explains just by interest rate differentials. And that after an increase by the ECB, they only rates at zero. And they're not even going to be doing any QT. They're still going to be reinvesting. And if anything, their balance sheet's going to go up in size if there are any problems in the peripheral countries. So I'd argue that a lot of the dollar rally has really been more interest rate differentials than anything. And I'd also say that if you're looking for inflection points here of what would stop the dollar rally, I think the first chink in the armor was when the Swiss National Bank all of a sudden came out and hiked 50 basis points. Not only was no one expecting them to hike, but they did it by 50. They're still below zero at 25 basis points, but that came out of nowhere. And then that was quickly followed by the Bank of Canada that hiked rates 100 basis points instead of 75. And all of a sudden, and the Reserve Bank of Australia hiked more than expected. And the Bank of Korea raised interest rates 50 basis points for the first time since they started changing interest rates back in the late 90s. So all of a sudden, these other central banks are getting tough, just as the Fed has. And the Fed's policy is not as out ahead of these others. So I think the dollar is looking sort of a bit toppy. Now, again, I think against the yen and against the euro, it's going to have its own unique characteristics and much less so against the others. And the Bank of England in August is going to increase their rate hiking cycle to 50 from 25, and they're already doing QT. So outside of the yen and the euro, I don't see the dollar rallying much more from here. Again, because I think a lot of that outperformance has been interest rate differentials more than anything else.
Interesting. Great observations. Your thoughts, Ira?
Well, my view is I believe that the strong dollar is a problem for the world only because of the amount of debt that was taken on at the behest of Fed policies. So, I go back and I always fluctuate between whether I'm with Jacques Rueff and discussing with Giscard d'Estaing that the dollar is an exorbitant privilege, or with Michael Pettis that the dollar is an exorbitant burden, because I think it shares both. And I think, as Daniel talked about with the Triffin dilemma, it's always an issue. So where is it here? Right now, I think the United States, this is not the Volcker years. Again, Daniel and I talked about it, Peter, there is no inner Volcker here. The world is far vastly different. The amount of debt that's on the books of a lot of borrowers, especially emerging market, not just public sector like it used to be, but private sector, corporations in the emerging market world, a lot of dollar debt. And with that, because that debt was creation of Federal Reserve policy, I would argue vehemently, just like in 2015, the real paradigm is the Swiss National Bank in 2015, because everybody felt comfortable borrowing. All Eastern Europe was borrowed in Swiss francs, right? I can get rid of my euros. I'm guaranteed the peg at 120, and rates are about 2% lower at that time in Switzerland. So I'm going to borrow Swiss francs until the peg was pulled. And then all that borrowing became very expensive borrowing. And I still think they're dealing with lawsuits out of that still today. Well, that's the way I look at the world. The world right now is heavily borrowed in dollars because of Fed policy. And now the dollar is going up with interest rates rising, and which is, as Peter talks about, I think it's absolutely right. Well, it's pushing the dollar higher, higher, and higher, which is making it the burden greater and greater and greater, which to me should pull the Fed back. The Fed has to be very careful here, because this is a problem that they created. You can pretend to look at the world with domestic lenses, but you've already, that ended long ago, especially I would argue once we went to the full fiat currency world of August 15th, 1971, we definitely get there. So we're there now, and you fulfill a different role, and you have to play that role, because the world right now, we've just seen a taste of it with Sri Lanka and Pakistan. There are many others. In fact, there's so many articles now being written. Even David Marsh's, they came out with a piece this morning talking about this and the threats that exist to the emerging market world. So I think the stronger dollar is not, and people are saying, well, it's good for the United States. I don't believe that. I don't believe that. I believe at one time that was okay, but the United States doesn't import energy because it's already, well, they do import energy, but it's already priced in dollars. Everything they do. So the impact of a stronger dollar on inflation in the US, I think, is much less. It's harmful, not harmful, but it's an albatross for, as we've seen with US corporations who are now talking about how much the strong dollar. It's hard to believe that they don't hedge all their exposure, but the hedging is getting expensive, as we've seen, because the swaps are expensive with the interest rate differentials are the way they are. So that's been going on, but corporations are, and the dollar, it's high. And I know the Fed will say it's not our responsibility, it's the Treasury responsibility. And yes, yeah, we know that. But there has to be some concern about it here. It's wreaking some havoc, and the Fed just can't pursue. That's the burden that it has to have. That, hey, we can't be inflation fighters like Paul Volcker was. The world's a far different place. The debt structure globally is far different, and we have to be attuned to that. Yes, back in March of 2020, we aggressively opened up the swap lines, which was needed, which prevented some type of disaster. But I think it puts the Fed in and it's a real issue of policy. If it's not an issue of policy, it ought to be an issue of policy, especially when we see the impact it's having on emerging market countries who have to import food and energy. So it's something I'm watching, it's something to be concerned about. Now, when Daniel and I were on, we talked about this, because the euro yen at 142 is another burden for Germany, especially because Germany competes directly.
Absolutely.
We had a long conversation. I wish I would have kept my I sold the cross at 142.30. That's what it was when we were on, and it recently got down to 137. And what's it trading at right now? We're at 136.5.
Yeah.
So movement here, and it is with the euro. The yen is kind of stabilized in there for some reason, and that's with the ridiculous talk from Kuroda. What the hell they're thinking about, I don't know. But the yen has stabilized in here, and I think it's been because of the yen crosses more than anything. It's not because anything Japan's done, because unfortunately Abe is gone. What they will do, whether they'll pick up, of course, the famous 3 arrows and what that entailed, and they got a weaker yen out of that. But I think the yen got too weak and needs to, and that's important for the world, because the euro is too weak, and the weaker currencies allow the dollar to then gain more and more traction. And I think that weighs very negatively on the emerging markets, and not in a good way. And on that panel from Sintra, where Powell was with Andrew Bailey, Lagarde, Powell, but also Augustin Carstens. And Augustin Carstens raised the issue that the country, we're not seeing an emerging currency problem yet. And that's because the emerging markets have been ahead of the Fed and others in raising their interest rates. in order to protect their currencies. Augustin Carstens was definitive about that. They're aggressive because they need to protect their currency because they're so heavily borrowed against the dollar. So I think it's something to watch, but that is ultimately a drag on the global economy anyway. So
There was an article yesterday, Ira, that you pointed out in the Center for Economic Policy Research. Speaking of currency, the IMF currency SDRs, special drawing rights, about purchasing grain using SDRs. Did you want to comment on that?
yeah, they're a left, more than left leaning, but it's two people who I have a lot of respect for. Dean Baker, who really was one of the first to foresee what was going to happen with the subprime and housing crisis. So I've always paid attention to his work, and his cohort, Mark Weisbrot. Well, Weisbrot put out a piece last week, again, something that Daniel and I talked about, which was buying up grain by the G7 using the SDRs, because they're big proponents of the SDRs. They're big IMF backers, meaning Center for Economic and Policy Research. So that doesn't surprise me. But I think it was something that was very important, because if you use SDRs, then nobody can scream too loudly. Yeah, eventually they'll get there to scream. But if you would have, and Daniel and I talked about it, had you started buying grain, some of the stockpiles, you would have put the squeeze on Putin, because the squeeze then would have been on India and China, because they would need to secure grain, because China can never be short of grain. Not going to happen. They must have food. More than anything else, is afraid of hunger in China. So they must. So if you would have bought up as much stockpiles outside of the Black Sea ports, you would have put pressure on India and China to put more pressure on, because Putin can't say no to India and China. They support him in his endeavors, and they're very important. So I thought that the CEPR piece, and they carry policy weight. So it's a proactive policy rather than U.S. suffers from being only reactive. So I thought that was a pretty good piece.
And Daniel, in terms of the ESG and sustainability movement, there's some that take a market environmentalism approach based on the Austrian School of Economics, but then there's a group also that takes an almost militant ESG approach. If you look at that, and also emerging climate change emergency initiatives, where do you see the implications for the investment environment, given what's happening?
I think that's a very important question, because for years we've been hearing that ESG as an investment concept generates higher returns than conventional investment, and that it's more sustainable and obviously less volatile. And unfortunately, what 2022 has proven is that it's the opposite. Pretty much like what we said about Bitcoin as an alternative to the US dollar, or as a hedge to inflation, become an anti-hedge to inflation. So ESG has proven to be as volatile as technology and as negatively correlated to the markets as the rest, but unfortunately also underperforming. So the problem now is double. On the one hand, what you have is that a lot of so-called ESG funds have started to play around with the concept. So now ESG includes investing in an integrated oil company that is reducing its carbon footprint, etc. Furthermore, the biggest problem is that putting too much exposure on ESG as an investment concept that was going to deliver an asymmetric return to the market has also created a backlash against new funds delivered to investments in environmentally friendly or sustainable investments. So that is a big challenge. That is a big challenge because on the one hand, what I'm worried about is that activism becomes more aggressive. At the same time, policymakers become less aggressive because, as you've seen, for example, in Europe, nuclear is now green. But we're forgetting that a lot of the capital that was moving to sustainable technology and renewables, etc., is starting to come out to other, at least less risky or at least for the moment more attractive opportunities. So I think it's a victim. ESG as a concept is a victim of its own hype, a bit like cryptocurrencies, that it has sold a story that should have not been sold to start with in order to attract capital, and is now making a negative impact on exactly what it should be defending, which is more investments in technologies and disruptive technologies, which would be the solution to the challenges of the energy and supply of food and water, clean water globally.
Interesting insight. And your thoughts, Peter?
I mean, ESG is always in the eye of the beholder. So you have, just to expand on what Daniel said, you can have two people. One thinks nuclear is ESG good, and another one would think it's bad. So you have this just entirely subjective concept. Also, at the same time, you can be sure that every Fortune 500 company or every Fortune 1000 company has consultants in their office saying, how do we become, how can we call ourselves ESG? So if every company can call themselves ESG, then what is it?
Exactly.
It's you look at some of these investment products, which we do, that slap on the ESG label, and all they are closet index funds because their top holdings are Microsoft, Alphabet, Apple, Amazon, and Tesla. They all own the same things, and they just follow the S&P, and they call themselves ESG. So to me, ESG is like Daniel said, a bunch of hype, and I don't even know what it means anymore. You take Philip Morris, the stock that we own. Well, I can argue that maybe it would fit some definition because they're trying to get people off from smoking cigarettes. But somebody else will say, well, smoking cigarettes, they can't have that. It's all in the eye on the beholder, and that's what makes it like sort of wishy-washy in a way. Like it's not a concept that has really any substance to it. We want to invest in well-run companies that respect their employees, treat them well, aren't frauds. They follow the letter of the law. They are whatever clean, however you want to define that. Yeah, we're always looking for that, but it's just how the elite have somehow wanted to define it, that it's made it purely subjective and therefore less, almost useless.
Yeah,
as a concept.
Absolutely.
Yeah. And your thoughts, Ira?
Yeah, I have just when Larry Fink put out that piece about deglobalization, now that they're up to 10 or 11 trillion under management, I laughed because Black I want to say BlackRock, but it's not. Yeah, BlackRock. BlackRock has been a big promoter of it, but ESG to me disappears if you think deglobalization is taking place.
Yeah.
Because part of it, of me going around the world looking to place capital, I was looking to help promote green programs. But as we've seen with what's going on with Russia and the energy, a lot of people are back burning coal, right? Even Germany is burning lignite, if I'm not mistaken. So things roll back. So if you're in favor of deglobalization, ESG by its definition has to change dramatically. And then when I'm a wise guy, I'll say, well, ESG, because when HSBC announced that they had a Communist Party committee now in the bank in Shanghai, because they felt it was smart to do. So somebody said, well, what do you think about that? I said, well, we have ESG. To me, because when you really drill down enough, they're sitting there in every boardroom and people are making decisions And then, then management tries to greenwash it, and then you get the role. I don't know. It's very complicated.
And on the E part, I mean, is Tesla E? Well, they just declared they were not. And you still have to dig copper and lithium and cobalt and nickel out of the ground. Well, that's not E, but then it goes into a battery that technically becomes E. I think people have thrown out physics of how to create a green, renewable future, understanding that you need to dig stuff out of the ground to make that happen. And that the truck that goes to the copper open pit that needs to take that copper, well, it's going on diesel because the battery hasn't been made yet. So I think that we can't ignore the details here of what it takes to get to this world that people want to get to.
And it's not going to be as quick as everybody deems that they so desire it. It's just not. If that's the lesson, and nobody does, that group out of Europe who does the work on energy, I have to say, I mean, it's just not there yet. And we're seeing it. And don't tell me the world ends in 6 years, right? Because that's where if that's the case, then nothing here we talk about even matters. Let's just roll everything up and be done with it, because that's what they're espousing now. I'm all in favor. And capitalism will there's so much money chasing clean water, decarbonization in so many different ways, carbon sequestration. There's a lot of money chasing these, and hydrogen. Let them work, and if you stop throwing roadblocks up, because they are doing it. Yeah, listen, I'm not a non-regulation person. I believe if you have good regulation, have good regulation. But ESG, as Peter it just digs deeper and deeper and deeper, and it's never ending, right? And even Elon Musk was laughing because Exxon had a higher ESG rating than Tesla.
Absolutely.
Can you even get there? So it just, you know what, it becomes a nice thing and everybody rushes to do it. But I think then you see things that roll back, like we need transition. Natural gas is a transition. Everybody agreed with that years ago. And yet you stop piping it and you stop drilling it. Well, you can't wish it away. And if we're going to operate in any type of capitalist, semi-capitalist society, you need energy to make things work. Human beings need energy. We need food. That's a different type of energy, so we all need energy. So, figure it out, but you can't wish it away.
Right. And just a final question, given our discussion on the factors and trends on the economy and the financial markets, where do you see the best investment asset classes or sectors? Energy, metals, agriculture, different regions of the world. Daniel?
What we see basically is that right now is a good opportunity to get some exposure to agricultural commodities and also to some of the industrial commodities that have underperformed recently. We like technology here. We like technology here because as the market starts to digest the rate hikes, while at the same time perceiving, and rightly so, that central banks are going to continue to be accommodative, I like some exposure into technology. And our preference remains in the U.S. market. Big difference is no matter what, and someday it'll change, but it is nowhere to be seen, is share buybacks added to a much healthier margin to earnings growth than in the case of European stocks, for example. And we try to avoid regulatory risk sectors. We've been very lucky this year avoiding banks, utilities, and telecommunications in developed economies. So That's what we look at. I don't like emerging economies. I think that emerging markets have a double risk. If the currency goes south, the market goes south, and if the situation in the economy doesn't get better, then the government starts to eat away the returns. So I'm not looking particularly positive on indices in emerging economies. We have some exposure to specific stocks and bonds. We like investment grade here, and we are completely away from sovereign bonds.
Interesting. And Peter, your thoughts?
So we're pretty bullish still on energy, precious metals. Ag, I like. We had sold our fertilizer stocks after the war started and prices spiked, but they're tempting to get back in because I still think that crop prices are going to remain very high, and even next year, when you think about the fertilizer that's not being sprayed this summer, is going to lead to less yields, and certainly for next year as well, as farmers sort of economized these very high fertilizer prices. I actually think if I'm right on the dollar peaking out here, I think some emerging markets actually will become attractive if the dollar tops out here. Again, because their central banks have been pretty aggressive in tightening. And when you look out over the next 10 years, I think that growth in Asia, the rise in the middle class of Asia, is going to be one of the more exciting investment stories. And whether that's in India or even China and the rest of that region, Indonesia, I think pretty bullish on the Southeast Asia, particularly Singapore. I think that there are some cheap opportunities, and these are markets that have done nothing for the past 10 years, and they've dramatically underperformed. And then even in the US, there's still a lot of good value stocks out there that this recent decline have given people an opportunity to own at cheaper prices. And one thing that I like to say is that bear markets, even though they're tough to go through, and we're clearly in one, bear markets are usually the best time to be buying stocks or anything, because that's where the best values are created.
Mm-hmm. And your thoughts, Ira?
Yeah, I'm pretty much in the same camp. I will say with Daniel, but as long as we talk about ESG, I still, one stock that I buy on all the breaks is ABB, the Swedish.
I own it too.
They pay a nice dividend, but they fit the ESG profile probably better than any company. I mean, they've got their hands in every element of it. If ESG is really going to go forward, ABB, which is a huge company, I mean, they have 110,000 employees. I mean, and they do some great work, and they just spun off their turbine business, I think. So it's just something to watch. So it's one of the companies that I really like because I know ESG isn't going away. It's just, does it get contained a little bit? But of all the groups, I love that one. I love industrial companies that are engineering based, and they fit it, and they're getting their financial house in order. And I think the raw material producers are still good. I'm a big fan of the ags as they are. And it's interesting how the ags get beat up when they have a miss, like, Bunge missed. They beat the hell out of them, but yet they're still, high quality company. The only problem with these companies, of course, is what kind of acquisitions they do and how much debt they take on. Yes, it's the same with mining companies, right? Every time they get money, they were like the old telecoms. The more money they had, the bigger mistakes they were going to make. But I still love all those. I think I'm watching the Japanese market here for many reasons. So paying attention to it, because I think Japan is a good story yet to unfold.
We're bullish on it too, Japan.
Yeah.
You like Japan, both of you? Interesting.
Yeah.
Japanese equities.
Japanese equity.
Yeah.
That's
and even if the yen goes back to 120, I mean, it's not a ridiculous level for the yen. It would probably help and I like that the Japanese have agreed to turn on 10 or 11 reactors that had been turned off. So
by winter.
Yeah, they're trying to get somewhat ahead of this. I know Europe just doesn't. I keep looking at Germany, and I know they have a problem because the Greens are in the coalition, and the Greens just view nuclear energy as verboten, if I may say so. But it's not a good thing. But it's interesting. I have a lot of confidence in Lindner. It'd be interesting to see what happens with him and this government, because this stoplight coalition really is not serving them well at this juncture. But basically the same things. And I'm looking for stocks that have been heavily sold off that I really think have value to them. And again, I like engineering sectors, but AB&B is my favorite because they measure really high on ESG investments. So I always think that that's one that's going to be accumulated slowly. But outside of that, I will get more bullish to U.S. if the dollar were to start to sell off. I think the stronger dollar is a problem. I think it's a problem for U.S. banks. I think there's a lot of hidden problems there with a strong dollar. That's the way I see the world.
Great, awesome insight, gentlemen. How can our listeners learn more about your work, Daniel?
Oh, it's difficult not to find me. It's probably easier to avoid me, I think. That would be probably the task ahead, to avoid me. The best way to find me is my website is dlacalle.com, and you have it in Spanish and in English. You have my YouTube channel in English, Daniel Lacalle in English, and you have my two Twitter accounts, one in English, one in Spanish. So, I come back to the point. It's easier probably to avoid to find me than to avoid me. So looking forward to the discussion.
Great. And Peter?
You can read my daily macro market missives at thebookreport.com. It's actually bookreport.com, BOOCK report.com. And if you are interested in reaching out from a wealth management perspective, we're at bleakley.com. And my Twitter handle is at @Boockvar.
Great. And Ira?
Well, through notes from underground, I haven't been writing in a while because my eyes, I'm just recovering from some issues, but everything will be better and everything's getting better. I'm getting back up to my reading speed. So I'm there. And I'm a big fan of both of these. So this is a great honor. Daniel, I'm a latecomer to Peter's work has been, I've had years of it now, especially through this. So I advise people read that. And interestingly, both of these people, there's an article today in the Financial Times by Howard Marks. I'm a big Howard Marks fan. And the title of the article is really great. And it fits everything we talk about here today. Let me grab it. The title of the article was really good. And I know Daniel and Peter subscribe to this because that's what separates them. But Howard Marks talked about, where is that article?
That's why his newsletter just came out.
Oh yeah, but he talked about not to go with the herd, right? To stay with the herd and think about things more in depth, and you'll be amazed at what you'll find. And I think this ability to interact just like we're interacting serves that so well. But I advise everybody to read that Howard Marks piece because it's really a tribute to what we're sitting here and what you try to do, Richard. Get people to think about things. A lot of things going on that are more than just what the headlines read. I think very, very important. And I think that's what we strive to do and keep coming to this site. And Richard, you got to get this stuff out there better because everybody needs to get on top of it.
Okay. Great. Thank you so much, Daniel, Peter, Ira.
Thanks so much. Always fun, guys.
Thank you.
Thank you. Great fun. A great pleasure to be with such great people. Thanks a lot.
Yeah, thank you. Pleasure.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.